Meet Sam. Sam just got their first real paycheck, $4,000. Sam is already mentally spending it, a new phone, a trip, maybe both. Then the paycheck actually shows up, and it's not $4,000. It's more like 3,000 and change. Somewhere between you earned this and it's in your account, a small army of invisible hands took a bite. Not one bite, 4 or 5 separate bites from different directions for different reasons. And here's the wild part. Most Americans pay these taxes their entire lives, and still couldn't explain how any of it actually works. So today we're taking the most confusing tax system on earth, the United States tax system, and breaking it down so simply that by the end of this video, you'll understand it better than most Americans do. No jargon, no boring lecture, just Sam's paycheck, one bite at a time. Here's the first thing that trips up literally everyone outside the US, and plenty of people inside it. America doesn't have one tax system. It has 3, stacked on top of each other like a cake. At the top, the federal government, that's the national government in Washington, D.C. It taxes your income no matter which of the 50 states you live in. In the middle, your state like California, Texas, or New York. Some states also want a slice of your income, some don't. And at the bottom, your city or county, local taxes that quietly show up too. Your city or county, local taxes that quietly show up too. So when Sam got taxed on that paycheck, it wasn't one system taking a bite. It was potentially 3 completely separate governments, each with their own rules, each taking their own cut. Today we'll mostly focus on the biggest one, federal tax, because that's the one that confuses people the most. Then we'll zoom out to state and local at the end. Let's say Sam makes $60,000 a year. A lot of people, including plenty of Americans, think it works like this. You're in the 22% bracket, so the government takes 22% of your entire $60,000. Nope. That is the single most common myth about US taxes, and it's wrong. Here's how it actually works, and this is the concept that unlocks everything else. The US uses a progressive tax system with tax brackets. Think of your income not as one block but as a stack of water glasses, and each glass has a different tax price to fill it. For 2025, for a single person, here's how the glasses are priced. The first $11,925 you earn, taxed at just 10%. The next chunk, up to $48,475, taxed at 12%. The next chunk, up to $103,350, taxed at 22%. Then 24%, then 32%, then 35%, and finally 37%. But that top rate only kicks in once you're earning over $626,350 a year as a single filer. So for Sam, making $60,000, only the money above $48,475 gets taxed at 22%. Everything below that was taxed at the lower rates first. Sam's overall real tax rate, what we call the effective tax rate, ends up way lower than 22%, even though people say Sam is in the 22% bracket. This is why getting a raise never makes you take home less money overall in the US, even if it pushes part of your income into a higher bracket. Only that extra sliver gets taxed more. The rest stays exactly the same. If your uncle at Thanksgiving tells you to turn down a raise because it'll bump you into a higher bracket, he's wrong, and now you know why. Before any of those glass-pouring math happens, though, Sam gets to shrink the target. This is where deductions come in. A deduction reduces the income that gets taxed in the first place. Almost everyone in the US gets something called the standard deduction, basically a chunk of income the government agrees not to tax at all, no questions asked. For 2025, that standard deduction is $15,750 for a single person, or $31,500 for a married couple filing together. So Sam's real taxable income isn't the full $60,000. It's $60,000 minus $15,750 before any bracket math even starts. Some people skip the standard deduction and instead itemize, adding up specific expenses like large medical bills, mortgage interest, or charity donations, if that total is bigger than the standard deduction. But most people just take the simple standard one. Simpler is usually better. Now here's the part that trips people up. Deductions and credits are not the same thing, even though people mix them up constantly. A deduction shrinks the income that gets taxed. A credit is way more powerful. It shrinks the actual tax bill, dollar for dollar, after everything else is calculated. For example, the child tax credit gives parents up to $2,200 per qualifying child, taken directly off the tax bill, not just off taxable income. And the earned income tax credit, designed to help lower-income workers, can be worth over $8,000 for a family with 3 or more kids. So deduction equals smaller target. Credit equals literal cash taken off what you owe. Credits are the bigger deal. Okay, here's where it gets interesting because we've only talked about one tax so far. Federal income tax. But remember those gremlins from the start. There's a second, completely separate set of teeth taking a bite out of every paycheck, and it's called payroll tax or FICA. This tax funds two specific programs. Social Security, basically a national retirement fund. You pay into it your whole working life, and then when you retire or if you become disabled, you get monthly payments back. Medicare, a national health insurance program, mainly for people 65 and older. Here's the rate. 6.2% of your paycheck goes to Social Security and 1.45% goes to Medicare. That's 7.65% total, and it comes out automatically. You never even see this money to decide whether to pay it. But here's a genuinely wild fact most people don't know. Social Security tax has a cap. In 2025, once someone earns more than $176,100 in a year, they stop paying Social Security tax on anything above that. A billionaire and someone making $176,100 pay the exact same dollar amount into Social Security. Medicare, on the other hand, has no cap, and high earners actually pay an extra 0.9% on income above $200,000. So it's the opposite system in that one case. And here's something that surprises a lot of people internationally. Your employer pays too. For every dollar taken from your paycheck for Social Security and Medicare, your employer quietly pays a matching amount out of their own pocket on top of your salary. You usually never see this number, but it doubles the actual amount going into the system. If you're self-employed, though, there's no employer to split the bill, you pay both halves yourself. That's called the self-employment tax, and freelancers, this is exactly why your tax bill feels brutal. Remember that 3-layer cake from earlier? We've only covered the federal layer. Now let's zoom into layer 2, state tax. Here's the twist that makes the US genuinely unique. Your tax bill can change dramatically just by moving across an invisible line on a map. Most states charge their own separate income tax, stacked on top of the federal one. But 9 states, including Texas, Florida, and Nevada, charge zero state income tax. People genuinely move states specifically to avoid this bill. Meanwhile, some states like California can charge over 13% on top of what the federal government already takes at the highest income levels. Same country, wildly different bill. Then there's sales tax, a tax added at the checkout counter when you buy something, not when you earn it. This is genuinely confusing for international viewers because in a lot of countries, the price on the shelf already includes tax. In the US, it usually doesn't. That's because sales tax rates are set locally, by state, and sometimes even by city or county. So the same product can cost different final amounts depending on which store you're standing in, literally blocks apart. And finally, local governments, cities and counties, often add their own smaller taxes too, usually funding things like schools, roads, and police through property taxes if you own a home, or small local sales tax add-ons. So by the time all 3 layers are done, Sam's money has been touched by potentially 5 or 6 different tax types before the year is even over. Here's something that confuses almost everyone new to the US system. Your employer doesn't wait until the end of the year to send your taxes in. They estimate your tax bill every paycheck and send a chunk directly to the government immediately. This is called withholding. Then once a year, by April 15th, every working American has to file a tax return. A form that calculates exactly what they actually owed for the whole year, compares it to what was already withheld, and settles the difference. If too much was withheld throughout the year, Sam gets a refund, money sent back. If too little was withheld, Sam has to write an extra check to cover the gap. Now here's a myth worth busting. A big tax refund is not a bonus or a gift from the government. It just means Sam gave the government an interest-free loan all year, overpaying every paycheck, then getting their own money handed back months later. A lot of people actually get excited about their refund every spring, without realizing they basically just got their own money back late. So let's rewind. Sam earned $4,000 in that very first paycheck. By the time it landed in the bank account, here's everywhere it had potentially been touched. Federal income tax based on progressive brackets, not a flat bite. Payroll tax funding Social Security and Medicare. Possibly state income tax, depending entirely on which of the 50 states Sam lives in. Sales tax, waiting to nibble again the moment Sam spends that money. And potentially local and property taxes on top of all of it. It sounds chaotic, because honestly it kind of is. The U.S. tax system is really several overlapping systems wearing a trench coat and pretending to be one. But once you understand the core idea, progressive brackets, deductions versus credits, payroll tax funding specific programs, and taxes existing at 3 separate government levels, the rest is just details layered on top of a pretty simple foundation. Sam still doesn't love paying taxes. Nobody does. But at least now Sam and you actually understand where the money goes and why. If this helped you finally get it, do us a favor, like, share, and subscribe for more.